The Minority Market. Episode 16. Why most advice is designed to trap you. Most people enter the stock market looking for guidance. They search for advice, tips, expert opinions, and strategies that promise clarity and confidence. This seems reasonable. After all, markets are complex. But here is an uncomfortable truth. Most advice in the market does not exist to help you succeed. It exists to attract attention, create dependence, and transfer risk from one participant to another. Until you understand this, you will remain vulnerable. The market advice ecosystem is built on incentives, not truth. Media houses need viewership. Influencers need followers. Brokers need transactions. Educators need customers. Very few participants are rewarded for telling you to do nothing, wait patiently, or manage risk conservatively. Excitement sells. Certainty sells. Simplicity sells. Reality, unfortunately, does not. Most advice is designed to appeal to emotions, not discipline. It feeds hope during rising markets and fear during falling markets. When prices are rising, advice encourages participation. When prices are falling, advice encourages panic or urgency. This emotional amplification keeps the majority reactive and predictable. The minority learns to recognize this pattern and step away from it. Another trap lies in generalization. Advice is usually broad, context-free, and one size fits all. It ignores your capital size, time horizon, emotional tolerance, and experience level. What works for a long-term institutional investor may be disastrous for a short-term trader. What works in one market phase may fail completely in another. Blindly following advice without understanding context is one of the fastest paths to loss. There is also the illusion of authority. Titles, confidence, charts, and jargon create credibility. People assume that confident voices must be correct. But confidence has no correlation with market accuracy. Many advisors are excellent storytellers, but poor risk managers. They highlight wins, hide losses, and change narratives after the fact. The minority understands that outcomes do not validate advice. Process does. Another subtle trap is survivorship bias. You only hear from those who succeeded, not from the thousands who failed using the same advice. This creates unrealistic expectations and false confidence. Advice often focuses on extraordinary outcomes, not sustainable behavior. The market, however, rewards consistency, not heroics. Free advice is not harmless either. Free content often has hidden costs. It trains you to seek external validation instead of developing internal judgment. Over time, you stop thinking independently. You wait for confirmation from others before acting. This dependency weakens discipline and increases emotional vulnerability. The most dangerous advice is advice that removes responsibility. Statements like "this stock cannot fail" or "this is a sure shot" encourage oversized risk. When losses occur, blame shifts outward to markets, manipulation, or bad luck. The minority takes full responsibility for decisions. Responsibility creates learning. Blame creates repetition of mistakes. Another issue is timing. Advice is almost always delayed. By the time it reaches the public, the risk-reward balance has already changed. Early participants benefit. Late followers absorb risk. This is not conspiracy, it is structure. Markets reward early conviction and punish late certainty. The minority approaches advice differently. They do not reject all information, but they filter it aggressively. They ask, what is the incentive behind this advice? Who benefits if I act on it? What risk is being ignored? Does this align with my plan and time frame? Most advice fails these tests. Instead of searching for answers, the minority builds frameworks. They focus on understanding behavior, risk, probability, and process. They learn principles rather than predictions. Over time, this reduces the need for external input. Silence becomes more valuable than noise. A powerful shift happens when you stop consuming advice and start observing markets directly. You notice patterns without commentary. You see price behavior without explanation. This builds confidence grounded in experience, not opinion. The goal is not to become cynical. The goal is to become selective. Good information exists, but it requires effort, patience, and critical thinking. The majority wants shortcuts. The minority accepts the work. If you remember one thing from this episode, remember this. The market does not reward those who follow the most advice. It rewards those who think independently, manage risk, and act deliberately. When you stop outsourcing your thinking, you take the first real step toward becoming the minority. This is not isolation. It is self-reliance. And in markets, self-reliance is survival.